Okay, so if you're a business owner, there's a question that probably keeps you up at night. Are we actually making any money? I mean, you see the sales coming in, the revenue looks pretty good on paper, but then you look at your bank account and you're just wondering where it all went. Well, don't worry, you are not alone, and today we're going to give you the tools to finally get some real clarity. Let's say you run a small online t-shirt shop. You're selling a bunch of shirts, money's hitting your account, and hey, that feels like a win. But after you pay for the blank shirts, the printing ink, your website subscription, and all the shipping, what's really left over? That gap between just being busy and actually running a profitable business is exactly what we're closing today. All right, so the very first step is to get a crystal clear picture of your costs. Think of this like giving your business a financial x-ray. You see, not all costs are created equal. They fall into two really critical categories that behave in completely different ways. First up, we've got your fixed costs. These are the bills you have to pay every single month, no matter what. It doesn't matter if you sell one t-shirt or 1,000 of them, your rent is still due. Then you've got variable costs. These are the costs that are directly tied to your sales. The more t-shirts you sell, the more you'll spend on the shirts themselves, the ink, and the shipping. Understanding this difference is the first huge step. Okay, so now that we know our costs, we can start to build our profitability compass. This is your guide to what is probably the single most important number for any new business, the break-even point. It's that magic moment you finally stop losing money and start making it. Let's just cut right to the chase here. We need to figure out the exact number of t-shirts you need to sell just to cover all your costs, your rent, your materials, the whole shebang. What's that magic number that gets you to zero? Well, to find it, we just need one more simple idea. And that idea is called the contribution margin. I know. It sounds like something straight out of a textbook, but I promise you it's actually really simple. See, for every single t-shirt you sell, some of that money has to immediately go to pay for the shirt itself and the ink, right? The little bit of money that's left over after that, that's your contribution margin. So here's the best way to think of it. Every single t-shirt you sell contributes a small chunk of cash to a big pile. Your first job is to make that pile big enough to pay off all your fixed costs for the month, like your rent. Once those are paid off, every single chunk of cash that comes in after that is pure profit. Okay, let's do the math. It's way easier than you think. Let's say you sell each t-shirt for 25 bucks, and we know the variable costs, the shirt, the ink, are $15. So 25 minus 15 leaves you with $10. That's your contribution margin. Now, let's say your fixed costs for the month, your rent and software, are $200. We just do some simple division. We take that $200 in fixed costs and divide it by the $10 we make from each shirt, and that gives us 20 shirts. That's it. That's your magic number. You need to sell 20 shirts just to break even. But here's the exciting part. The 21st shirt you sell, that $10 contribution margin isn't for rent anymore. That's your profit. And that, right there, shows you the power of knowing your numbers. Look, breaking even is about survival, and that's great. But we're in business to thrive, right? So let's use this exact same logic to set an actual profit goal and figure out exactly how we're going to get there. So let's say you want to make $600 in profit this month. Here's the really cool part. You just treat that profit goal like it's another fixed cost. So you take your original $200 in fixed costs, you add the 600 bucks you want to make, and now your new target is $800. We do the exact same math as before. We divide that $800 by the $10 we make from each shirt, and we get 80 shirts. And just like that, you have a concrete, totally actionable sales target. This isn't guesswork anymore. It's a clear plan. You know exactly what you need to do to hit your financial goal for the month. All right, so you know how to break even and you know how to hit a profit target. Let's talk about risk. How much of a sales dip can your business actually handle before you start losing money? Let's talk about your safety net. In the accounting world, this is called the margin of safety. It's simply the gap between what you're actually selling and what you need to sell just to break even. A big margin means you can handle a slow month, no problem. A tiny margin means you're operating a little too close to the edge. It's your buffer zone. This chart is awesome because it shows you exactly what's happening visually. See that line for total revenue going up and the other line for total costs? The exact spot where they cross, right there, that's your break-even point. Anything to the left of that point, you're in the red, losing money. To the right, you're in the black, making a profit. And the distance between your actual sales and that break-even point, that's your margin of safety. That's your cushion. So now you have the tools to really understand your business. But here's the thing. Sometimes our own brains can trick us into making some really bad decisions, even when we have all the right information. Let's talk about two very common mental traps you need to avoid. We're going to talk about chasing sunk costs and forgetting about opportunity costs. And trust me, these aren't just boring accounting terms, they are decision-making biases that can cost you real hard-earned money. Let's start with sunk costs. This is money that you have already spent, and you are never, ever getting it back. Imagine you bought a $5,000 t-shirt printer, but now there's a much better one on the market. It's so tempting to keep using the old one just to feel like you got your money's worth, right? That's a huge mistake. That $5,000 is gone no matter what you do. The only question that matters now is what's best for your business going forward. Next up is opportunity cost. I like to call this the what-if cost. It's the value of the road not taken. So, if you can make $400 working a part-time job, but you choose to take a week off at the beach instead, the opportunity cost of that vacation is $400. Every single decision you make in your business has a hidden opportunity cost, the profit you could have made by choosing the next best thing. And that really brings us to the core takeaway here. All of these concepts, fixed costs, break-even points, safety margins, they aren't just for spreadsheets. They are the actual tools you use to make smarter, more confident, and ultimately more profitable decisions in your business. So I'll just leave you with this question. Now that you have the tools to really understand your business's financial engine, what's the first lever you're going to pull? Are you going to adjust your pricing? Find a clever way to lower your variable costs? Or maybe set a bold new sales target? The choice is yours.